Hey everybody, Brian Shannon here. It is Friday, the 13th of December. Hope you had a good week in the markets. Actually, let's start out by taking a look at the numbers here. Across the board, we were kind of mixed, mostly lower actually. Biotechs got rocked, as did the Russell 2000. Dip buyers got exactly what they deserve. And I don't say that to be mean. I say it because, I bought a stock below declining 5-day moving average this weekend, and I lost this week. I lost money, and I got exactly what I deserved. How often do you hear me say, don't buy things below declining 5-day moving average? The good news is I recognized the mistake very quickly, and it was a super small loss. But the point is, we're never, no one's immune to making mistakes in the market. And this market is giving you opportunities to make bad mistakes if you're trying to buy the weakness, bonds in particular as well. So let's take a look here first off at this trading view list, that is. And we've got the SPY in the upper left corner. That, of course, is the declining 5-day moving average. And this is the anchor from that prior high, which had been support earlier in the week. It is looking a little bit shaky here. The NASDAQ, another new all-time closing high. Semiconductors had a good day on the heels of Broadcom, and the Russell 2000 just remains a dog. Before I forget to talk about them, let's talk about crypto. Bitcoin is still flirting with that 100,000 level. It has this beautiful pattern of higher lows, and I still would prefer that it shakes out down towards that 92,000 level. I've got a bid in there for some. It may not happen. There's some real strength here, and these higher lows are indicating that each dip is being bought more aggressively at a higher price. Buyers aren't waiting for a pullback to 88,000. They're not waiting for a pullback to 91 or 93. They instead took control at 95,000. In Ethereum, I'll update that. As I said, I bought it over here. I haven't touched it. I'm just leaving that be. Let's take a look at equities now. The S&P 500, as mentioned, trapped below that 5-day moving average. This purple line is the week-to-date volume-weighted average price. The orange, of course, is the 5-day moving average. The blue is the anchor from the beginning of the month. So we're below all of those, and that puts us in a little bit of a defensive mode in terms of the S&P 500. This is our most recent, most important level of what has been support in here. And if that fails, then I think you've got a test coming of at least the 20-day moving average, maybe even the anchor from the election. The anchor from the election would bring it all the way down here, but of course we've got to keep in mind that this 600 level is an area that might find buyers. But the fact is, wherever it, maybe it just turns around the way the semiconductors did. But for now, it's guilty till proven innocent, and it seems likely that it will do something along the lines of this, which is, to maybe flirt with this, come down to that 600 level and either recover or come down all the way to the anchor from the election. That's the way I'm looking at it for now. So going into next week, I'm very defensive on this. I update this every single day, twice a day, for Alpha Trend subscribers and for the Twitter subscribers. For Twitter subscribers, it's just $10 a month. $10 a month gets you analysis of the markets each and every day, Bitcoin as well. I do a live webinar each month where I answer educational questions. That one is next Wednesday at 8 p.m. Eastern. So go to twitterx.com, look at Alpha Trends, and sign up for $10 a month. It's an amazing deal. The NASDAQ, like I said, all-time high here, being driven higher by the leaders, of course, and we've still got the pattern of higher highs and higher lows above a rising 5-day moving average. The market's getting quite stretched, so a pullback at some point next week shouldn't come as a surprise. It doesn't, there's nothing here indicating it will, but just given the magnitude of the recent rally, you want to be aware of where your stops are so you don't get blindsided. Don't become complacent just because the market seems to go up every day. Instead, look at it and say, I need to protect my gains from my time frame. As you know, I talk here only about swing trades. I'm a swing trader. I'm not interested in making predictions about what the market will do in 2025. I'm interested in what it'll do. On January 1st, I'll be interested in how's it behaving today? How's it behaving compared to the last 3, 4, 5 days of last year? And each and every day is a new day for risk and risk management. That's my focus, not on the trends of what's going to happen next year. Nobody knows. You can guess all you want. But Russell 2000, this is why you don't buy the dip. I've been saying it. You've heard me here the last couple of weeks saying, we've got this pattern here, lower highs, lower lows, declining 5-day moving average. Buy the dip at your own risk. and the people who have purchased because they think, hey, well, the Russell 2000 is where the market ought to go next. It doesn't matter. The fact is, we've got declining 5-day moving average, lower highs and lower lows. We're broken below the anchor from the election. So since the election, the average buyer of the Russell 2000 is losing money. The average short seller is making money. Now, that doesn't mean it's going to stay that way, of course. We have to look below and say, what are our next potential levels of interest where we might find enough demand to become support? Potential levels of support. That's what we're looking for. And we look at things like the anchor off of this low right here. That would bring us down to right in this area, about 231. We also see we've got a rising 50-day moving average. That's that blue line right here. And that 50-day moving average has been support previously for this market. So maybe it will be again. Maybe it will be. We just don't know. So we want to look at it and say, that's where we have the potential to find buyers. So maybe it comes down to that level, and then it starts to bounce a little bit. As you know, what I would be looking for, if you're new here, then you'll go back and look at some of the archives, but what I would be looking for down in that level is for a move that would set up in a low risk way. So coming down like this isn't necessarily a low risk. It might bounce like this for a couple days, go sideways, and then once that 5-day moving average has had a chance to flatten out, and then it gets back above that flat to rising 5-day moving average, so long as this move right here doesn't get extended, then I would be a buyer right at this point with my stop most likely under here, perhaps under there. That's what I'm looking for a turnaround. Maybe it does a V bottom at that point, and that's fine. I don't care if I missed that. I can't tell you how many trades I've missed in my 30+ year career. That, missed money is better than lost money, as they say. And my discipline is to not buy dips, not buy pullbacks. I didn't buy the semiconductors at the 200-day moving average, even though that's been a good level of support this year. Buyers have been there numerous times, and the market has bounced. Now we've got a declining 50-day moving average. Next week, we're getting rid of this data right here. So that means that 50-day moving average will start to look like this, flat to declining, because we're getting rid of this data here, unless we get some kind of miraculous rally in the semiconductors. Now, the good news is on the shorter term time frame, 30 minutes for each bar here on the right, and you can see I've got about a month worth of data, is that we're back above the month-to-date anchor. That's that blue line. We're back above the anchor from the election. This is the week-to-date anchor, and here's the 5-day moving average. So maybe next week, if this is going to recover, it can do something like this. Shake it around a little bit towards that 5-day moving average, then perhaps buy some strength. What would be the leader here isn't always what has been the leader. This is what I've been outlining as a potential scenario for NVIDIA, is that NVIDIA has a pattern here on the intermediate term, lower highs and lower lows below a declining 5-day moving average. Look at how it's respected that 5-day moving average and found sellers there, and then got hit hard from that level a couple times. So when we look at the daily time frame, what I was outlining here, let me just erase this line so we can kind of see the price action, is that this is a possible scenario for NVIDIA. Maybe we undercut this low right here, and that is right here. So we undercut that low and this anchor, then we get a bounce, create a lower high, and then a drop down to the anchor off of this low. Again, it's never meant as a prediction, just a potential scenario. So the bottom line is maybe the semiconductors are going to recover, but they're not going to, it doesn't appear, because of the price action in NVIDIA. Instead, today's action was driven by a VGO, Broadcom. And look at that chart, longer term time frame. Look at that versus NVIDIA. I don't know what's the bigger gainer. I bet NVIDIA, but still, just a beautiful trend. And they had earnings this week. News and surprises tend to follow the direction of the trend. So this is our new leader in the semiconductors. What's a dog? AMD is a dog. It's in a downtrend. There's no point buying a stock below declining 20 and 50 and 200-day moving average. Similar to Intel. Actually, I haven't looked at Intel, and that continues to be a dog as well. So go where the strength is. Don't look at the yesterday's winners trying to think that they're going to lead again, not while they're in downtrends. They need time to heal, to recover, establish an uptrend, and then they can be the leaders again. Until then, they're just best left alone, stocks like I said, NVIDIA. So biotechs. Biotechs are just getting smushed. They just get sold day after day here the last couple days, and they did it after a break of this level right here. This support that was forming for the for the biotechs was at the anchor from the election. That's that black line. We finally gave way. I think this was on, what was this, Wednesday? And it is just getting rocked from here. Down below a declining 20 and 50-day moving average tells me even if we get a bounce in here, it's guilty till proven innocent. You can get a bounce straight out of it, but don't look for anything more than a bounce. It's not about to turn around and create this beautiful uptrend. So look at this and say, you know, is this where your best odds are in the biotechs? I don't think they are. I think they're best left alone. Financial stocks, is this where your best bet is? No, this has had this huge run, as I've been mentioning. The pattern of higher highs and higher lows above the rising 20-day moving average has failed a couple last week. We're also below the anchor from the election, right here. I know a lot of people look at gaps and say all gaps must get filled. That would be a monster gap fill from here. It wouldn't be a monster gap fill. I mean, that's really only 3 points lower. It's not huge, but I certainly wouldn't want to be long in there. Does this look like a shoulder, a head and a shoulder maybe? You know, a lot of times head and shoulders patterns do this. They break the neckline and then they go on to squeeze. And that's certainly a possibility. The point is you can't get locked into a belief that just because we see this head and shoulders pattern on this time frame doesn't mean it's automatically going to go down and fill that gap. If the stock reverses and does something like this, the financials, well, then you've got to respect that and throw your bearish scenario away. The other thing is, if you are bearish and think it's going to fill that gap, keep in mind the longer term trend is still higher here. We've still got, look at this weekly chart. That is not a bearish chart. It's just a chart that's in need of some consolidation, pullback, and maybe rebuild for something along the lines of this, into the first quarter of next year. That is the path of least resistance on the weekly chart, but we have mixed messages on different time frames. This says high caution in regard to the financials. Energy names just been dogs, and I've been hammering this point here for the last 3 weeks ever since we broke back below this prior band of resistance. It did not hold as support at that prior resistance. So a lot of people will tell you resistance broken becomes support. No, it tends to become support. So you don't blindly buy there. Sometimes you blindly buy there and get lucky and it goes. That's, I don't want to create, my career success isn't based around luck. It's about strategy and being okay with missing a move like semiconductors, not buying at the 200-day moving average, because I know that it can just as easily fail at a level like that and fail at the 20-day moving average, fail at the 50, fail at the 200, fail at the year-to-date anchor. There is just no support being found for these energy stocks. We still have a crystal clear pattern of lower highs and lower lows. What would, where would this become a buy for a bounce candidate? One, I don't trade energy names, so, not something I would do, but maybe it rallies up to that 5-day moving average and slightly through it. I wouldn't trust it because this is more likely is what would happen is something along the lines of this. That 5-day moving average comes around, flattens out, so just like I drew in the Russell 2000. I would want to be a buyer here above this little higher high, above a flat to rising 5-day moving average with a stop below the most recent relevant higher low right here. My stops are always the same. My price targets are always the same. They're, it's a strategy, it's a system, and that's what I teach every single day. That's what I write about in my books. Let's talk about bonds because they're doing exactly what they're supposed to do. If you remember me talking about them a couple weeks ago, I said, highly unlikely that this continues to move, that these bonds continue to move higher because we have a declining 50-day moving average and we are at this year-to-date anchor. We got a couple more days of rallies and some wise asses on Twitter said, see, you're wrong, Brian. Well, guess what? Here we are now. They can continue to rally a little bit, but if you've got a declining 50-day moving average, a rally is typically going to fail to hold. So just leave these alone. There's no reason to trade bonds. They're in a long-term downtrend. The Fed is meeting next week. They're supposed to cut by a quarter basis point. Last time they cut rates, right here on this date. That was the last day that they cut rates. So what does that mean for bond yields? Let's look at it in terms of the yield. TNX, here it is. So that was right here. That's the last time they cut interest rates. Why has the 10-year yield gone from 365 to 439? Doesn't make sense. Doesn't need to. We're here to make money trading. What we want to do is look at the trends, get involved in those trends when they make sense, and avoid nonsense like the energy names as they're in downtrends. I hope you had a good week of trading, and I'll talk to you next week. Thanks.